Thanks, Cheryl, Sandeep, and the Republic team for setting this up today. My name is Kevin Weatherman. I'm the co-founder and CEO of Lever Health, a personalized coaching platform designed to help you eat better, move better, and sleep better. But the reason that we're talking here today is I'm also an active angel investor. I started my career in ad tech and was part of the early team at MoPub, which got acquired by Twitter. I started angel investing in 2013 and have since invested in about 100 startups, half of those direct and the other half through AngelList syndicates. I've done one Republic deal, as well as multiple SPVs, which I'm sure they're going to walk you through that term later today. Today, I'm going to walk you through what I wish someone else had told me as I got started angel investing. So we're going to talk about what is an angel investor, why do you want to be an angel investor, how to actually go about being an angel investor, and then how to help founders. As Cheryl mentioned, only 11% of angel investments see a positive return. 9 out of 10 times the money you put into a company you will not get back. Let's talk about what an angel is. From my definition, an angel is typically the first person to put money into a company. You're often meeting founders before they've set everything up, before they've structured their business, before they've been able to present to Republic to go through due diligence. Angels help with making introductions. Angels help with operations. I've walked companies through how to set up a recruiting pipeline, how to hire your first employee, how to onboard your first employee, how to set up a sales plan. So we can be very helpful when it comes to operations as angels. And then most importantly, an angel investor, in my view, helps raise the first institutional round of capital with the founder. But let's talk about why do you want to be an angel? Remember, 90% of deals go to zero or don't get their money back. As Cheryl mentioned, the average liquidity is 9 years. Illiquidity is 9 years. So you can expect to not get your money back for a long time. Remember that if you give great advice to founders, they're probably going to ignore you. Companies rarely send updates. I think between 10 and 20% of the companies I invest in send me an update once a year, if not less often. And as Cheryl will walk you through later, the percentage ownership that you have in the company gets diluted over time. Versus you can put money in the stock market, you can put money in today, take it out tomorrow. You can know in real time how much your company is worth. So why would you want to invest in this asset class? Because as we mentioned, once a decade, you have an opportunity potentially to invest in Amazon, Google, Facebook, Uber, and turn a $25,000 investment into $124 million, like Jason Calacanis did with Uber. But let's talk a little bit more about why you want to be an angel, because you're probably not going to be Jason Calacanis, and you're probably not going to be the person that gets that 5,000x return. So most people I know become angel investors because at one point in time in the future, they want to start their own fund or join someone else's fund as a venture capitalist. If you have a lot of money and you want to diversify, there's a good argument for why you should become an angel investor in order to diversify across an asset class that is not associated with the S&P 500. Again, this is something you want to talk to your financial advisor about. And because of platforms like Republic and others, you can get started investing in very low dollar amounts into these companies that you, again, might not see returns on for 5 to 10 years. As an early employee, one of the things that I love doing is working closely with founders, helping them figure out their businesses. So that's one of the main reasons that I am an angel investor, because I like working with founders and CEOs, helping them go from 0 to 1. And then I also really like being part of the ecosystem. A big part of why I love angel investing is meeting a company when it's just getting started, helping them figure a few things out, potentially having my friends go join that company and building out a great business and being part of, especially the New York ecosystem of startups, which I'm a big part of. So let's talk about how to be a good angel. So again, these are the 4 recommendations that I wish somebody had sat me down and said, do these things before you write your first check. Develop a thesis or multiple theses on what you're looking to invest in. For me, the future of work being virtual, the extension of mobile, and the future of machine learning and how it's going to impact business are all things that I'm really excited about investing in. So start with developing a thesis. Next, I'd encourage you to figure out asset allocation and check size. For round numbers, let's say that you want to do 20 investments, and assuming that 9 out of 10 of those deals are worth 0, that you're okay with investing $100,000. Your check size is $5K. The next big thing that everybody's going to talk about is deal flow. And deal flow for me has come from 2 places: my network or syndicates. So you can get started today, sign up with Republic, sign up with AngelList syndicates, and start seeing deal flow tomorrow. If you are an accredited investor, if you're not through Republic, you can start seeing deals immediately. So that will allow you to start seeing deals. The other way to get deal flow is let everybody in your existing network know that you are an angel investor, and you'll be surprised how many people loop you in as potential investors for deals. And then the Republic team is going to have you go through a lot of due diligence. I think the thing that I would advise any angel investor to think about when it comes to due diligence is, why would you not invest? As an example, if the co-founders fight with each other in a meeting with me, they're probably spending a lot of their time arguing in person as well when I'm not in the room. And so that becomes part of my set of red flags that go into my due diligence when I decide whether or not I want to invest in the company or not. So now let's talk about the fact that you've decided you're going to write a $5K check. You're investing in the thesis that you believe in. You found a company that matches that thesis. You've written them a check. How do you become a great angel investor? By helping the founder. So figure out the things that you're really good at. For me, it's sales, it's operations, putting together business plan, figuring out how to scale a team. These are all things that I can really help founders with. Next up, I would say it's so easy to answer emails. If a founder sends you an email that says asks, here are the things that they are asking for your help, just do those things. Most of the time, they're very easy things. I'm looking for an introduction to one of these 5 people. Pretty easy to do. Don't be afraid to ask for updates. If you haven't heard about from the company in 6 months, it's fair for you to ask for an update and see if you can be helpful in any way. And then I always encourage my angel friends to follow and share the companies. So one of the first things I do after I write that check is I give them a list of ways that I can be helpful. I give them some feedback on how I would set up a lot of the operation stuff. And then I make sure that I follow them on all social, especially LinkedIn. And then anytime they post, I'm the first person who hits the share button. So now let's talk about some of the companies I've invested in. Rent the Runway was through a platform called Equity Zen. Clubhouse I invested in through AngelList. Arbor was a direct investment that I made where I had a pro rata, which they'll talk to you about later. And I did my follow-on pro rata, and then the company was acquired by LiveRamp. And so those are just 3 examples of the different types of ways that I get access to deals and the ways that I go about making my angel investments. It's like if you'd like to reach me, you can email me, kevin@kwangel.fund. You can DM me, pubkevin, on Instagram or Twitter. And now I'm thinking handing things over to Cheryl and Sandeep for a Q&A.
That's exactly right. Thank you so much, Kevin. Appreciate that presentation. Let's start at the top. How did you start your angel investing journey?
So I started my angel investing journey by actually going to angel.co, looking up deals. I actually found a deal that I was very interested in, reached out to the founder directly, and wrote a very oversized check that I wish, again, that I had the diligence to put together a right check size. That was also the company that the founders were fighting with each other in my first meeting, and then I should have walked away. So I learned the hard way by writing a very large check on my first deal, where I wish I hadn't. But I got started angel investing because I had the windfall from the MoPub Twitter deal and suddenly had the opportunity to put 5 to 10% of my net worth towards angel investing.
Got it. And I should say that the policies on both AngelList and Republic, I believe, now state that investors are not allowed to reach out to the founders. So that's no longer possible.
I believe you. I didn't know it at the time.
So it sounds like the next question is, how did you learn to angel invest? And it sounds like trial by fire, but maybe you can share more about your education journey.
Absolutely. So I think when it comes to angel investing, the first thing that you learn is oftentimes you're not even going to get access to deals until you start letting people know that you're angel investing, which is why I really encourage people to sign up for a lot of syndicates in order to just start seeing what a deal looks like. And so I really think like the learnings from angel investing have come from doing deals. But the nice thing between Republic and Angel, like you can get started on AngelList with a check as small as $1,000 as an accredited investor. You can get started on Republic with a check as small as
it depends on the founder, but as little as $10.
Little as $10. So the ability for you to start getting experience and small dollar amounts makes sense in the same way that somebody would sign up for Robinhood and sort of figure out how to trade the public markets. I think you would be able to, again, you really want to, this is a one-time decision made once every 10 years. And so you really do want to be sure that you're deciding to invest in that company in a different way than you would the public markets. But it is really important to build that experience. And the great thing about these platforms that didn't exist when I got started is the ability to get started before you become an accredited investor and in smaller dollar amounts.
I think that's one thing I do want to underscore to folks is on platforms like Republic and AngelList, you can sign up without any commitments. You can just basically see the deals and just start learning what you like, what you don't like. Is that right?
You can sign up for Republic and do that, but on AngelList, you have to be an accredited investor, I believe,
right,
in order to see the deals.
But just from you don't have to commit is the point. You can just start seeing deals.
Correct. And that's how I got access to both Rent the Runway and Slack was through EquityZen that doesn't require, this is for later stage things, much larger minimum check size. So their minimum check size is $20,000.
Got it. You mentioned something about kind of finding your thesis, et cetera. How do you determine what kind of angel you are? Thesis is part of it, but your risk profile, what you're looking for, et cetera.
So by default, the risk profile is 10 out of 10 as an angel investor, especially if you're, first money into the company. So I think that let's just be honest that 9 out of 10 of these deals are going to go to zero. And do you think you can pick the 1 out of 10 that is going to go much better than that? I think you have to be honest with yourself that you think you can. In terms of, I envision a world 10 years from now that I think should exist or could exist. And I focus the thesis on which companies are going to actually make that happen.
Hmm.
And so I think from a standpoint of, I remember one of the first public market investments I made was in an ATM company because I didn't believe that bank tellers were going to exist 10 years ago when I was in my teens. This is
Hmm.
so much easier to just walk up to an ATM, put a check in the machine instead of talking to a person. And so I think you start thinking about like, what's the world going to look like in 10 years?
Hmm.
And betting on founders who share the same vision that you do. Other than that, I mean, I look at the strength of the team. Have they done this before? I mean, there's a lot of things that go into my due diligence that allow me to walk away from a lot of deals. But ultimately, the thing that I'm focusing on is, do I share the same vision of the future, which is where that thesis comes in with these founders? And then figuring out how I can be helpful. I mean, sometimes it doesn't make sense other than writing a check to be helpful. In other cases, I mean, I've been part of, helping build out a management team. I've done offsites with my portfolio companies. And so it really depends on which ways that I can be helpful to them.
Got it. And I think one other thing I want to clarify is it sounds like when you angel invest directly, you perhaps one of the first checks in, but on platforms like Republic, AngelList, and others, you're oftentimes co-investing with other investors. And oftentimes, I know on Republic, for example, it's actually not the first round. So just angel doesn't have to always be first check in, I guess, the clarification.
It definitely does not have to be the first check in. I would say of the 100 deals that I've done, 80% of them are valued below 12 million. So I think it depends on sort of where they're at. Sometimes it is a seed round as opposed to a pre-seed round. Sometimes they've raised money from friends and family or put their own money in before I'm putting in. Yes, it doesn't have to be first dollar into the company, but it's typically one of the first line items on the cap table.
Yeah, fair enough. Sounds like you've got a sort of vision, 10-year vision for the future. What are just, if you talk about brass tacks, things that you look for when you're investing, what are the top 3 things that you're looking for?
So the number one thing that I look for is, do I want to work with this founder for the next 10 years if this goes well?
Mm-hmm.
And so that's a big part of throw out market, throw out 10X, throw out product, throw out all the other things. Is this somebody, assuming this is going well, that I want to be working with on the cap table, them helping me out, me helping them out for the next 10 years, which is why 4 of the deals that I've done, I invested in their previous failed company and am now doing a second investment in their new company because these are the type of founders that I want to work with over and over again. Outside of that, I start thinking about what has to go right in order for this company to be worth hundreds of millions, if not billions of dollars.
Mm-hmm.
So sort of building up that best case scenario of, okay, let's say that they do everything that they have in their seed deck and they deliver on all of that and they get another round of funding. What has to occur for them to be able to deliver on that? And then I would say the other big thing that I'm looking for is this a solution that scales?
Mm-hmm.
And I think that's a big, especially early, the difference between, is this something that a venture capital company wants to invest in versus is this a good business?
Mm-hmm.
And so the big difference there, can this company go from 0 to 10, from 10 to 100, and from 100 to 1,000 in a matter of 4 years? Can they really see that exponential growth of whatever it is their main metric is? And if the answer isn't yes, and they can just double every 2 to 3 years, then it's not the type of company that venture capitalists are going to get excited about.
2 things I want to kind of underscore in what you just said. One, when you talk about founders that you want to work with, I think that's oftentimes a proxy for their ability to attract other people to their team, especially given how talent really is the key constraint these days, not necessarily capital. And so if it's a founder you want to work with, hopefully that means that other people want to work with them and they'll be able to hire well. Is that appropriate?
Yes, and bedside manners. Just like if I'm going to have a hour-long coffee with this person and spending time with them, like they can bring great people to the team, but still not be someone that is nice.
Fair, fair. People have different styles. I'll give you that. The other thing I want to kind of underscore is just sort of your profile when you talk about returns. I think definitely certain times when people are investing, sounds like you specifically, you're saying, okay, if I invest in X, what's the likelihood that a venture capitalist will come in and invest at a higher valuation and that money will keep growing? I think sometimes companies are still, to your point, potentially good businesses, but it's perhaps a different return profile. And it sounds like you're interested in the return profile of the potential Ubers, not necessarily in those that you're like, yeah, I'm investing at 10 million. I can see this becoming a $100 million business, but if it's not going to be higher than that, then I don't want to get involved. That's a personal choice, you think?
It is.
It's a general rule?
For KW Angel Fund.
Yeah.
Because I either see myself as joining a VC fund sometime in the future or starting my own. And so going back to like, why am I angel investing? Like if I can't identify a good percentage of those 1 in 10 companies that are going to have that exponential growth and return all of the money that I've put in, then I shouldn't go and try to do that professionally, either managing other people's money or as part of a firm.
Yeah. I think the why matters a lot. You're very clear on your why, and I think you highlighted that in your presentation is investors should know why they're investing, not just thesis, not just what they're interested in investing, but why they're investing, and have that guide what they invest in.
Yeah, because if you care about like near-term returns and liquidity and other things like that, again, you can go in the public markets and you can buy Shopify at the IPO, and you made just as much money as if you were an angel investor in Shopify.
Right. I'm going to try to pivot a little bit to some questions from the audience. Some of these are around carried interest. In summary, how do you view carried interest as affecting your decision? The fact that, for example, an AngelList, they charge carried interest.
So I think,
and actually, just define carried interest for folks who are unfamiliar. So on some of these platforms, when you invest, it's not just you're putting in your capital and whatever it might happen up or down. It's if there is a return on that capital, the syndicate lead or the platform will take a portion of that upside as their fee.
Yep. I don't care about it at all. The way I think about it is 9 out of 10 deals don't have any carried interest because they don't give any money back. Right. So on the 1 out of 10 that does have carried interest, it's worth paying for because I probably wouldn't have otherwise had access to it.
Got it. Fair enough. I know you hinted at that first check you wrote that the founders were maybe fighting. Walk us through just another bad one, something that maybe more recently, a lesson learned that even a now almost veteran investor like yourself, a mistake that you still made.
Yeah. So I think in general, I've made the mistake of investing because I knew a co-founder and not the CEO. And so as an investor, I think it's really important to get to know the CEO because that's the person making a lot of decisions. And so if you trust the co-founder makes good decisions, but you don't know if the CEO makes good decisions, then you may end up investing in a good team that makes bad decisions.
That's fair.
So that was one. And then I think the other thing that came to mind was I had a company that was hoping they could scale with software, but started scaling with people. And they weren't really able to bridge that chasm. Mm-hmm. And I think that was one of those things where they had a little bit of success building software to scale it, but they weren't quite able to do that. So they started using humans in order to get to a Series A. and it sort of like ruined everything because they
Yeah.
became dependent on humans doing everything instead of software doing everything. So
Yeah.
I think from the lesson of like, it's okay to follow the YC, like do things that don't scale
Yeah.
to get from 0 to 1, but you really have to have a great plan in place to get from 1 to 10
Yeah.
quickly
Mm-hmm.
using software.
Right. Something that scales. One of the most upvoted questions here from the audience, in developing a diversified portfolio, if you had, let's say, 50 grand to invest, was it better to invest $1,000 in 50 companies or $100 in 500 companies?
If you can do $100 in 500 companies, I would do that. I would probably encourage you to pick like 20 or 25. Going back to the like 1 in 10 is going to be successful. So you want to give yourself 20 or 30 opportunities to find a successful company. So that's where I would encourage you to go with that dollar amount. I think that if you make, I mean, I made one $50K bad investment, my first investment. It went to 0 months after I made the investment. So if I had done version 2 to start, I would have ended up not ever writing another angel check ever.
The other thing I think to keep in mind is occasionally, not always, you talked about dilution, and I know Cheryl did as well. There is opportunity to put more capital into companies that are doing well. And people have different approaches and theories on it, but perhaps at least if you were interested in having the optionality of continuing to invest in companies that are doing well, setting aside capital for that.
I've had 6 opportunities to do pro rata. 4 of them I did. 3 of those 4 companies were some of my best investments.
Something, yeah, it's an interesting opportunity to put more capital to work in what may look like the winners. So
Yeah.
definitely should be part of the strategy.
But most of the time, if you don't have it contractually, the pro rata, you're probably going to get pushed out of the best companies. So like my best 20 companies, I didn't have the opportunity to do any pro rata because I got pushed out as an angel.
Yeah, understood. Another question from the audience here. How to approach founders to express interest in angel investing? Have you always had a personal relationship? Have you reached out cold? What's your approach when you? I know you get inbound, but let's say you find a company you like. Do you have to have a prior relationship?
You definitely do not have to have a prior relationship. I have done deals through my outbound. Oftentimes, if you hear about the company, it's probably already too late. There are some times that you can get in earlier. I think the better thing to do from a deal flow perspective is add on LinkedIn that you are an angel investor, and then let your network know that you are actively looking to talk to founders to angel invest and be helpful. I mean, you never know if you can just, if somebody's not raising right now, but you help introduce them to, 5 other investors or 5 of their first 10 clients or whatever it may be, they're going to be the first call that they make. You're going to be the first call that they make when they do start fundraising again. And so being there for that. The other thing that this reminds me of is if you say yes to a deal, make sure you follow up, because twice I've said, yes, I'm interested in investing, shaken hands, and then 2 months later find out on TechCrunch that they've raised a round and I'm not on the cap table.
Right. Fair enough. Once you want to commit, make it happen.
Correct.
Fair enough, especially if the opportunity is in demand. There's a question from the audience about typical angel investment amounts. I think that's it's being a personal decision. You had a windfall that enabled you to write larger checks. Different people have different financial situations, so I think it's tough to say typical. I can speak to minimums. Republic, for example, oftentimes the minimum ranges between $50 to $100, even though it is as little as $10 depending on the founder. You said AngelList have minimums of $1,000. Some of the later stage platforms have minimums in the $20, $30, $50,000. But I think that's a personal situation answer. Would you agree?
I would caveat that and say my average is around 10 to 12. And so there are some deals that I've done at 25 and 50, and there are some deals that I've done at 5, but for the most part, it's around 10 to 12. The other thing to think about is the founder doesn't want to have 50 different companies writing them $1,000 check on their cap table to get that money in. So if you are doing direct, the minimums tend to be higher in the 10 to 25K for a direct investment. As Lever Health, when we did our previous round, we actually partnered with a syndicate so that we could accept as little as $1,000 as an investment. And so people could sign up as an LP. They could get access to the round for as little as 1,000. And then if they wanted to go direct, we had a higher price. So I think that that's like striking the right balance in terms of what you're looking at. Again, if 10 out of 10 deals go to zero, you have to be okay with that. And so whatever risk you're comfortable with is what you should be making your personal check size. And if the company comes back to you, I mean, going back to mistakes that I've made, and says our minimum is 25 and I say my minimum is 10, I'm okay with missing out on a deal.
Only invest what you're comfortable investing.
Yep.
2 last questions. One is, in your opinion, what separates a good angel investor and a great angel investor? And how can someone start building those foundations to be great?
So I think great for me has to do with proactive helping of the company and helping of the founder, as opposed to reactive. You can be a good angel investor when somebody asks you for help and you just help them out. You can be a great angel investor if they send an investment update and they have 3 open roles that they're hiring for, and you proactively reach out to your network and refer them candidates.
Mm-hmm. And I appreciate the perspective with which you answered it, which is in the view of the founder, or at least maybe the view of yourself. How do you view yourself as a good or great? Just let's pretend that it may or not be true that the person asking the question was asking it from a return perspective. Is there anything separates a good angel investor or great from a return perspective?
Great. Yep. Good to reframe. I think great angel investors have great deal flow. And so the more that you can be perceived within the founder community as, go talk to this angel, they will A, help you figure out how to raise more money, and B, be extremely helpful, because you're going to miss 100% of shots you don't take. Oftentimes as an angel investor, you'll not even see a deal if people don't know that you're available. And so great angel investors, I would say, see more deals, and then they have a great framework for making the decision on whether or not they angel invest.
Awesome. Last question. Between a great product and a great CEO, which would you choose?
CEO.
There you have it, folks. All right. Thank you so much. Oh, you have something else to add?
I was just going to say, twice I've made investments pre-product with a great founder and seen that bear a lot of fruit. And there's been a few investments that I've made in a great product that just didn't have the leadership to get the funding to help them scale. And so I think you can have a great product, but I think as a company, what the company needs is product and funding. And so it's really important that they get access to capital. And that's where the great CEO can help with that.
Yep. Fair enough. Look, Kevin, really appreciate your insights. Really enjoyed the conversation. Cheryl, I believe we have a break for a few minutes. Can you maybe confirm that and let people know when we get back started?
Yeah, absolutely. And thank you so much, Kevin, for, those amazing gems that you have dropped on all of us. I think there's been so many questions, by the way. And Kevin, before you leave, please make sure to drop in your Twitter handles, Instagram, all of that in the chat, so that if people want to go and, continue the conversation, they can. So thank you so much, Kevin. Appreciate your time.
Absolutely, will do. Thank you for the Republic team for giving me the time.
Thank you. So I'm actually going to